Welcome back to the deep dive. Today we're jumping into something, well, something huge. It moves trillions and hits everything from, mortgages to maybe even the price of your coffee. We're talking about the May 2025 U.S. Non-Farm Payroll Report, the NFP, fresh from the Bureau of Labor Statistics.
That's right. And we've waded through quite a stack of analyses, expert takes, articles, research papers.
Yeah, tons of it. Our mission, as always, is to cut through that noise, find the real story hidden in the data, and figure out what it actually means for global markets and especially the U.S. dollar.
So expect some maybe surprising facts, definitely some aha moments. We'll try to keep it clear, no overload.
Exactly. Let's dig in.
Okay, so this report, it's fascinating because the surface story, it looked, well, pretty decent initially.
Right, the headline jobs number, the plus 139,000, that beat forecasts a bit.
Yeah, consensus was maybe 125, 130K, so a slight beat. And the unemployment rate held steady at 4.2%, right on target.
Sounds okay, doesn't it? Stable, maybe
Yeah.
even a touch strong.
At first glance, yes. But that's where it gets really interesting, that surface resilience. It was deceptive in a way.
Deceptive how? What's the catch?
The catch is the revisions. Always look at the revisions. March and April's numbers, they were revised down significantly.
That is significant.
A combined 95,000 jobs less than previously reported. 95,000.
Wow. Okay, so that basically wipes out May's gain, doesn't it?
Pretty much. It completely overshadows it. And there were other hints of weakness, too, if you look deeper, like in the household survey data.
So the overall picture isn't stability, it's more murky.
Exactly. The market term is conflicting signals. And that puts the Federal Reserve in a really, really tricky position. It just complicates the whole narrative.
Conflicting signals. I like that. Because, yeah, digging deeper, you see these two opposing forces, right? One kind of hawkish, pushing one way.
Definitely. There's a strong hawkish signal in there, the kind of thing that normally gets the Fed thinking about maybe pumping the brakes.
And what's driving that?
It's all about wages, average hourly earnings, or AAG. That number was hot. It stayed stubbornly high.
How high are we talking?
Up 0.4% month over month,
Yeah.
which beat the plus 0.3% forecast. And year over year, plus 3.9%. Again, higher than the 3.7% expected.
Okay, 3.9% year-over-year wage growth. Why is that such a big deal for the Fed?
Because it's incompatible with their 2% inflation target in the long run.
Yeah.
Wage growth near 4% feeds directly into core services inflation. That's the sticky kind.
Right, so they can't really think about cutting rates with wages running that hot.
It makes it very risky. It damages their credibility on fighting inflation. So yeah, it forces them to keep that cautious tone, keep the door open to maybe even more tightening, even while other parts of the job market look weaker. It's the ghost haunting the Fed, really.
Okay, so that's the hawkish ghost, high wages. But you said conflicting signals. What's the other side? The dovish pull.
The dovish side comes from, well, first, those big downward revisions we talked about.
Yeah.
Almost 100,000 jobs just vanished from the previous months. And second, the labor force participation rate actually fell. It dropped 0.2 percentage points down to 62.4%.
Okay, fewer people in the workforce. What does that imply?
It implies a couple of things. One, real job growth, once you factor in the revisions, is probably well below what they call the break-even point.
Which is needed just to keep up with population growth, right? Around 100K a month.
Exactly. So we're likely below that. And two, it suggests that the steady unemployment rate, it might be partly a statistical illusion.
An illusion. How so?
Because if people get discouraged and stop looking for work, they drop out of the labor force. They're no longer counted as unemployed. So the rate looks stable, but it's not necessarily because everyone's finding jobs.
Got it. So discouraged workers leaving masks underlying weakness.
Precisely. And that strengthens the argument that the Fed's other mandate, the full employment one, is actually facing some real risks now. The job market is clearly cooling.
So it really is a paradox then. Hot wages screaming, don't cut rates, but a cooling job market and falling participation saying, maybe you should think about it.
That's the perfect description. A paradoxical release. It gives ammunition to both sides within the FOMC, the hawks and the doves.
Which means gridlock.
Pretty much. No clear, immediate policy shift. It cements that higher for longer idea for now because of the wages, but it also increases the odds of rate cuts down the line because the cooling trend is undeniable.
So the Fed's stuck. Policy paralysis.
That's the core message the market has to grapple with. The Fed can't really move decisively right now. They have to wait for more data, just emphasize data dependency and bide their time.
Okay, let's shift to how the market reacted. The immediate first-order effects. What did you see right after the numbers hit?
Well, it was pretty choppy, indecisive, volatile. That's classic when the market gets conflicting data like this. It
Hmm.
struggles to figure out the main message.
Did the dollar react strongly?
It tried. The US dollar index, the DXY, it spiked up for a moment on that hot wage number, but then it just couldn't hold it.
Yeah.
As traders digested the downward revisions, the dovish part, it gave back the gains.
Interesting. What about stocks?
Stocks actually went up. The Dow gained, what, about 0.8%?
Oh.
The market seemed to read it as not bad enough to signal a recession, but cool enough to keep the Fed potentially cutting rates later. Kind of a Goldilocks view, I suppose.
Okay, but that failure of the dollar to rally,
Yeah.
you said it couldn't hold its gains despite the wage number. That seems significant.
It's usually significant. Think back a year or two. A plus 3.9% year-over-year wage print. The dollar would have likely soared and stayed there.
So the fact that it didn't, what does that tell us?
It tells us we're likely in a regime shift. The old rules, the old market playbook, it's not working quite the same way.
Explain that. What's the old playbook versus now?
Okay, traditionally, high wages equals higher inflation fears, equals a more hawkish Fed, equals higher U.S. bond yields, equals a stronger U.S. dollar. Simple chain reaction.
Right.
But what we saw was high wages, but weakening job trends overall.
Mm-hmm.
Leads to the Fed staying on hold. Plus, you've got global central banks doing different things, plus political risks in the U.S.
Yeah.
And the result,
Yeah.
a weaker dollar, or at least not a stronger one.
So the traditional link is breaking down.
It is. It's strong evidence that other factors like politics, like what the ECB or BOJ are doing, are now more powerful drivers for the dollar than just one piece of U.S. jobs data, even wages. That's a massive insight for anyone trading or investing based on these numbers.
Okay, so if the immediate reaction was muted dollar strength and the Fed is stuck in this paradox,
Yeah.
what are the bigger ripples, the second and third order effects? You mentioned a golden cage for the Fed.
Yeah, the golden cage. It's this idea that the report has trapped them. They can't cut rates because of the wage inflation that would kill their credibility.
Right.
But they also can't really turn aggressively hawkish because the underlying job growth is slowing down. It's decelerating, maybe even nearing stagnation. Hiking rates aggressively could tip the economy into recession.
So they're caged, can't move forward, can't move back easily.
Exactly. It forces them into being passive instead of active. They can only react to new data as it comes in. They can't really get ahead of it and shape market expectations like they might want to.
And this passivity, it really stands out when you compare it to what other central banks are doing, right?
Absolutely. While the Fed is sort of stuck treading water, others are making moves.
Mm-hmm.
The European Central Bank, the ECB, they've already started cutting rates.
They've begun their easing cycle.
Correct. And the Bank of Japan, the BOJ, okay, they have their own issues, especially around tariffs right now, but their next likely move is toward normalization, maybe ending negative rates, not towards more tightening like the Fed might have considered.
So the policy paths are diverging. Fed on hold, ECB cutting.
Widening divergence. And that creates a really strong structural headwind for the U.S. dollar. Think about capital flows. If you expect Eurozone rates to end up, say, below 2%, while U.S. rates might stay near 4% for a while, but are expected to fall further eventually, well, the interest rate differential starts to look less favorable for the dollar long term. Some research points exactly that way.
So money flows away from the dollar.
That's the implication. This policy divergence is a key driver.
So connecting those dots, a passive Fed, active easing elsewhere. Does this point to a longer-term structural weakening of the dollar?
I think it does. That combination encourages global asset managers to look elsewhere, to diversify away from U.S. dollar assets. It's not just a cyclical trade anymore. It feels more like a structural shift.
Any signs of that shift happening now?
Yeah, look at USDJPY, the traditional correlation between that pair and U.S. Treasury yields. It's been breaking down. That's a big symptom.
What's driving the dollar now, then, if not just interest rates?
It seems to be much more influenced by broader concerns. Things like U.S. fiscal sustainability, the deficit, trade policy uncertainty, political risk. Investors internationally seem to be demanding a higher risk premium to hold U.S. assets now, and that exerts a steady, long-term downward pressure on the currency.
This sounds like it goes beyond just the economic numbers. It's about psychology, expectations. You mentioned reflexivity. How does that work here?
What reflexivity? Yeah, it's a fascinating concept, especially now. The market isn't just a passive observer reacting to facts. It's an active participant. Expectations and reality feed off each other.
Like a self-fulfilling prophecy.
Exactly like that. If the market believes something strongly enough, the actions taken based on that belief can actually help make it come true.
How does that apply to the dollar right now?
Well, there's a strong market expectation or belief that political pressures, maybe potential tariff policies, will eventually push the Fed towards being more dovish, towards easing policy to support growth, regardless of inflation sometimes.
Okay, so the market anticipates a dovish Fed down the line.
Right. And what happens next? Traders act on that belief. They
Yeah.
start pre-selling the U.S. dollar. They buy things that benefit from lower U.S. rates, maybe the euro, maybe gold, maybe even equities. We see evidence of this in the FX options market, more demand for bets on USD going up, or for protection against the dollar falling.
And how does that action feed back?
Here's the reflexive loop. That selling pressure weakens the dollar. A weaker dollar, along with maybe rising stock markets, creates slightly looser financial conditions. Ironically, this can partially offset some economic drag, maybe from tariffs, and it gives the Fed a tiny bit more breathing room to delay those cuts.
So the market action slightly changes the conditions the Fed faces.
Yes, but the underlying belief that the Fed will eventually cut remains and might even be strengthened. So when the Fed does eventually cut rates, which is still the most likely path eventually, it validates the market's initial belief. The loop reinforces itself. The market isn't just predicting the Fed, it's influencing the environment the Fed operates in. It's actively shaping its own reality in a way.
Wow. That's a lot to wrap your head around. So given this reflexive loop and the conflicting data, what's the overall market mood? Is it risk on, risk off? It sounds confused.
It is confused, or rather contradictory. The surface narrative seems to be this fragile, soft landing idea. Steady, maybe boring growth, no recession. That's why stocks could still rally after this NFP report.
Okay, soft landing narrative on the surface.
But underneath, look at sentiment surveys. Business leaders, their economic optimism has plunged, according to some reports. Investors, indices show months of risk aversion. There's a deep pessimism bubbling under the surface.
So risk on the surface, risk off at heart.
That's a great way to put it. The market is positioned for okay growth, but without deep conviction. It makes it very fragile, very vulnerable to shocks. The NFP report kind of solidified this state. Not bad enough to scream recession, not good enough to kill the idea of future Fed cuts.
So how do we even categorize this market then, if risk on, risk off doesn't fully capture it?
I think we need a new framework. Look at what's been happening. Stocks, usually risk on, have gone up, but so has gold, usually risk off. What do they have in common?
They both tend to benefit from a weaker dollar.
Exactly. So maybe the better framework now isn't risk on versus risk off, but pro-USD versus anti-USD. That's the real battle line.
And this NFP report, by trapping the Fed and highlighting the policy divergence.
It clearly empowered the anti-USD camp. That's why you saw the dollar struggle, while both stocks and gold found support. Their common factor was the expectation of a weaker dollar going forward.
Okay, this is getting clearer. The NFP report, with all its layers, affects different currency pairs differently. For our listener trying to navigate this, where are the main battlegrounds? Which pairs are most sensitive?
Good question. Identifying those is key. First, USD. This is the main arena, really. The purest play on that policy divergence.
Fed stuck, ECB cutting.
Right. That creates a natural tailwind for USD. It's become the primary way for many traders to express an anti-USD view. Any data that keeps the Fed on hold while the ECB looks set to continue easing, that tends to push USD higher.
Okay, USD is central. What else?
USD-JPY, this one's more complex. It reacts to the dollar, yes, but also to global risk sentiment and usually U.S. Treasury yields.
But you said that yield correlation is breaking down.
It is, which suggests USD-JPY is becoming more sensitive to those broader U.S. issues, political risk, fiscal concerns. And with the Bank of Japan also somewhat paralyzed, the yen side is less active, making it maybe a clearer reflection of USD sentiment right now.
Interesting. What about the commodity currencies, like the Aussie dollar?
EUD-USD. That's your classic global risk proxy. Very sensitive to the global growth outlook, which is murky thanks to trade tensions, and of course, heavily tied to China's economy.
So the NFP's soft landing vibe helps it a bit.
A little temporary support, maybe, but it remains really vulnerable if trade wars escalate or if China's economy takes a harder hit. It's walking a tightrope.
And USD CAD?
USD CAD. Another commodity play linked to oil prices, WTI, but also the Fed path and the relative U.S.-Canada economic strength. There's an interesting angle here. A weaker NFP report hurts the USD directly, but a weaker USD often helps boost oil prices because they're inversely correlated.
Ah, so a double benefit for the Canadian dollar, potentially. Weaker USD plus stronger oil.
Exactly. It can create a double tailwind pushing USD CAD lower. So It offers a slightly different, multi-factor way to play potential USD weakness.
Okay, we've dissected the report, the reactions, the theories, the key pairs. Let's bring it all together. What are the likely scenarios going forward? How should our listener be thinking strategically?
All right, scenario planning. We've mapped out three possibilities. The base case, the one we see as most probable, say 60% chance, is continued USD weakness. Bullish for other currencies.
And the logic there is?
The market keeps focusing on the bigger picture. The clear slowdown in job growth underneath the surface, the widening policy divergence with banks like the ECB cutting, and that reflexive loop where a political risk weighs on the dollar. Essentially, the market looks past the single hot wage number.
So the structural anti-USD story wins out.
That's the base case thesis. The market interprets the Fed's inaction as relatively dovish, keeping hopes of eventual cuts alive. Capital keeps favoring places like the Eurozone over the U.S., pushing USD higher. U.S. yields stay capped.
What are the signs confirming this scenario? What price levels?
Confirmation would be seeing USD break decisively above that key resistance zone, maybe 1.175-1.1800, and starting to target the 1.2000 psychological level. You also want to see U.S. 10-year Treasury yields unable to sustain a move above, say, 4.50 cents. And listen for Fed speakers focusing more on growth risks than inflation. Time frame. Medium term, maybe the next 1 to 4 weeks.
Okay, that's the base case. What's the main counter-argument, the scenario where the dollar does rally?
That's scenario 2. USD strength, bearish for other currencies. We'd put maybe a 25% probability on this, likely shorter term, maybe 1-7 days if it happens.
What triggers this?
The trigger is the market suddenly getting spooked by that plus 3.9% wage growth. The narrative flips from cooling to stagflation risk. Maybe upcoming inflation data, CPI, PCE, comes in really hot, validating the wage signal.
So inflation fears take over.
Exactly. Then you'd hear Fed officials, maybe the known hawks like Bowman or Waller, giving really strong speeches, pushing back hard against rate cut expectations. U.S. Treasury yields would spike, maybe the 10-year heading towards 4.75%. That sharp rise in U.S. yields would suck capital back into the dollar, causing a fierce short squeeze. EURD would drop hard, USD/JPY would spike up.
And confirmation signals for that?
Watch for U.S. core CPI printing above 0.3% month over month. See the 10-year yield close convincingly above 4.60%. Maybe the DXY reclaiming a key level like 97.70. USD would likely fail at that 1.1750 resistance and break below 1.1600 support, heading towards 1.150 or lower.
And the third possibility, what if nothing really gives?
Scenario 3, the sideways complex scenario or the volatility trap. Maybe a 15% probability, short to medium term, 1 to 3 weeks.
What does that look like?
It means the conflicting signals from the NFP are just perfectly balanced. The dovish pull from weak job trends cancels out the hawkish push from wages. Neither side can gain control.
So just range trading.
Yeah, likely volatile range trading. Traders are hesitant to make big bets ahead of the next big thing, maybe the next NFP report on July 3rd or those tariff deadlines mid-July. You might get geopolitical news causing daily noise, spikes in volatility, but no sustained trend.
G pairs just stuck.
Pretty much. Your USD chopping between support around 1.1600 and resistance near 1.1780. USD JPY bouncing between maybe a 142.50 and 145.000. You'd see failed breakouts, strong intraday moves that reverts by the close. Implied volatility might stay high, but spot prices just can't trend.
Okay, 3 scenarios. Base case USD weakness, counter-argument USD strength, and the sideways trap. Pulling it all together, which path seems most likely based on everything we've discussed?
Based on the weight of evidence that USD weakness base case still feels like the most probable outcome.
Why? What tips the balance?
The structural forces just seem more powerful and persistent right now. The policy divergence is real and widening. The political risk and its reflexive impact on the dollar are undeniable. And the underlying slowdown in the U.S. labor market, despite 1 month's wage number, is also clear.
And the market's reaction itself.
That muted reaction to the AHE number is the key tell. It signals this regime shift we talked about. The market seems conditioned now to view the dollar as something to sell on rallies, not buy on dips. It looked past the headline wage number to the deeper, longer-term trends.
Okay, so if USD weakness is the base case, what are some concrete strategic ideas for our listener? How might they position?
All right, based on that scenario, the main trade idea would be to consider being long EUR/USD. Maybe looking for opportunities to enter or add on dips, perhaps into that 1.1650, 1.1680 support area. The initial target will be moving towards 1.200. A stop loss could be placed below the previous key low, maybe below 1.1575.
Long USD is the primary. Any secondary ideas?
A secondary trade could be selling USDJPY, especially on rallies up towards resistance, maybe the 145 or 145.70 zone. Given the broken correlation with yields, it might follow the broader dollar weakness more closely now. Targets could be a retest of support around 142.5 or 143.00, potentially even 140.000 longer term.
And for those holding a lot of USD assets already, hedging.
Yeah, for hedging existing USD exposure, buying some out-of-the-money USD call options, or perhaps USD JPY put options, could be a cost-effective way to protect against that base case scenario of a weaker dollar.
Crucially, what are the biggest risks to this whole analysis? What could completely derail the USD weakness scenario?
Risk management is key. The number one risk, the biggest potential game changer, would be a surprise, comprehensive geopolitical de-escalation. Specifically, a major trade deal between the U.S. and its key partners, EU, China, Japan.
Why would that be so impactful?
Because it would instantly remove that political risk premium that's been weighing down the dollar.
Yeah.
You'd likely see a huge relief rally in the USD. Those tariff deadlines, July 9th, July 14th, are absolutely critical dates to watch for any news.
Okay, trade deal is risk number one.
Yeah.
What else?
Risk number two, an inflation shock. If we get a series of nasty upside surprises in the upcoming U.S. CPI or PCE reports, that could force the market to abandon the cooling narrative entirely and aggressively price in a much more hawkish Fed. That validates the USD strength scenario. Keep an eye on the next CPI release, July 15th.
And a third risk.
A hawkish ECB surprise. Unlikely, perhaps, but what if ECB President Lagarde suddenly signals a pause in their rate cuts? Maybe citing worries about tariffs causing inflation in Europe. That would narrow the policy divergence, undermining the main pillar of the long UR-USD trade. Her speeches, especially around the ECB forum, need close attention.
Wow, we've certainly covered a lot of ground. From that NFP report, strong headline, weak underneath, trapping the Fed's this whole idea of a market regime shift.
Yeah, it's clear the market isn't just trading the data anymore. It's this complex mix. Data, central bank divergence, politics, even market expectations feeding back on themselves.
So, the final thought for you, our listener, to chew on. What does this all mean? How much do our collective expectations about politics, about policy, actually create the economic reality we end up seeing?
Are we just reacting? Or is the market actively writing its own future script? What does that imply for how you invest, how policymakers react, how you navigate this constant stream of information?
Lots to think about. Keep digging, keep asking questions, keep that curiosity sharp. Thanks so much for joining us on this deep dive.
Yeah, thanks everyone. We'll catch you on the next one.